All right, let's try it. I'll put this problem, I'll work it, and I'll put it out on Canvas. What I would do for an exam is I would work multiple problems, and then once I have it down, I pick one problem, just work that one over and over again. And what would happen is I would memorize the answer to that problem. So in the exam, I struggled, I could work the problem I memorized. So I have the formula all down, just help me. I did that in one graduate class, memorize the problem just in case, and then that was the problem he gave on the exam. So when he gave the problem, I already knew the answers. So I won't do that for y'all. I'll definitely have a different problem, but it helps in your mind if, exam anxiety can cause you to just completely forget stuff. But if you have a problem memorized, oh, I remember that problem, the answer was 3.7, plug it in. Oh, I didn't get 3 points. Well, I forgot to put the parentheses there or something like that. So, all right. This is really, really good. This is real life stuff. This is how firms, especially banks, this works well for banks. It's a little bit too simplistic for a life insurance company. All right, anybody want to, well, first, to get the duration of net worth, you had to get the duration of assets. What was the duration of assets here? 3.6, right? 10% was at 0, 90% was at 4, so 0.9 times 4. Duration of assets was 0.9 times 4, or 3.6 years. All right, and so the duration of net worth equals someone give me the whole thing.
3.6 minus parentheses 850 divided by 1,000 close parentheses times 3 close parentheses times 4 parentheses 1,000 divided by 1,000.
All right, does that sound right? Now we know for it to be equals 0, duration of liabilities have to be longer than duration assets because assets are smaller. So we know they're going to have a positive duration of net worth. How positive is it? What numbers were y'all getting? Exactly 7?
Yeah.
Anybody get 8 or 12 or 3? Exactly 7. All right. It's possible in the exam I'll have a really even number. I won't guarantee you that. It makes it a lot easier for me to grade it if it's really even numbers. So kind of cheating on my part. But it doesn't look like it'd be an even number because 1,000 divided 150 doesn't sound all that even. All right. That's a really long duration for a bank. If interest rates were to rise 200 basis points, what would their net worth do? Fall 14%. All right, that'd be an awful lot. All right, so let's say, what if interest rates fall 150? So what's the formula? Minus duration, change in yield. So equals minus, and this is the way I like to write it. Their duration is 7, but positive 7. So I do minus, parentheses, plus 7 times the change in yield is they fell. If you need to, you can do 150 divided by 10,000 if you can't convert 150 into 0.015. And so that's going to be what? It would rise 15, what I have, 10.5%. Is that right? Is it 10.5%?
Yeah,
right. Now, be careful here, because I don't ask you the percentage change in net worth. Ask you for net worth. So what would net worth be?
165.
Yeah, so 850 times 1 plus 0.105. And what do you get there? How much?
It's 160.
Oh, 150. I'm sorry. 150. So
65.
all right. I don't you don't lose all your points if you stop there, but the answer is there. I say okay. How are we doing so far? Scale to 1 to 10. Everybody's a 10 so far, or 9, 7.324, whatever. Okay. So how are they doing? So we just, if interest rates were to rise 100 basis points, what would their net worth do? Fall 7%. Are they in compliance? What if rates rise 200 basis points? Their net worth would fall 14%. They're out of compliance. They're okay when rates fall because duration, their duration's positive, but when rates rise, they're exposed. So they fell on 2 of these. So what is the question actually asking here? So let's look at that. So I would say duration of net worth is too high. So bank needs to reduce the duration net worth by doing what?
Increasing duration of liability.
Yeah, increasing duration. I'm gonna use you can on the exam use abbreviations, duration liabilities. Now the real answer here, if you really want to get into it, you can reduce duration of assets, increase duration liabilities, or enter a swap to go from what to what? Floating to fixed. All right. And you can get it. We got into a little bit more. How do you decrease the duration of assets? Well, the assets of a bank are loans. So instead of doing 5-year loans, you do 2-year loans. So it disrupts operations. How do you increase the duration of liabilities? Well, your liabilities are savings accounts, CDs. You go to longer term CDs, disrupts operations, or you enter a swap. All right.
We'll give this points because we magic.
As long as you explain what magic is, but no, I don't mind. I think it's magic. All right, so a lot of students completely miss this one. Some students get 80% because they leave off a little bit, but what does this imply? So it's really easy on the board. You just look at the 100 and whatever percent is there, you take the percent off and that's what the duration can be. So what would it be in this case? Yeah, so you got to put that plus or minus 5 years. So 6 years is not good, minus 7 years is not good, plus 3 years is fine, minus 4 years is fine, but it has to be plus or minus 5 years. There are 7 years, so the duration is too high. There's not a lot of essays here. You can get you might could add a little bit more here, but it's mainly a math problem. All right, questions on the first part. So we've measured this. We know they got a problem. Any issues there? All right. So over here, what's the first thing we do over here? I get the difference. So you write the difference there. The difference here is what? 240. And here, 60. Just like you would expect. So this one's a normal one. So AAA has the advantage with which one? A higher number or the lower number? Higher. BBB has the comparative advantage where? Lower number. All right. AAA has the advantage in both. We talk about absolute. We're talking about comparative advantage. If you want to think about it, AAA has a huge advantage on fixed. BBB has less of a disadvantage on floating. However you want to word it, but it's that whole idea. So, which company has comparative advantage on fixed? So AAA, which is the norm, probably on the exam, but don't assume it. But AAA, that's the norm. It's the norm because of that idea of the term structure of credit spreads. Higher quality firms tend to be better off longer term than shorter term, just because you'd rather loan money to someone who's safer the longer out you go. All right. Now 6, you can draw the chart if you want to, but you don't really have to. So the first thing they're going to do is they're going to go out and borrow where they have the comparative advantage, which is what you did on that first problem. There's nothing magic. There's no magic there. They're just borrowing money. So AAA is going to go out and they're going to borrow fixed rate because that's where they have the comparative advantage at T plus 10. And look how I do. I do plus T plus 10. All All right, I like to have whole thing lined up, and then the swap, they're going to receive treasuries. So you receive, that's if you receive, that's minus. I'm talking about the cost of debt. So if we receive, that's reducing your cost of debt. They're also going to receive 90. So they receive T, they receive 90. Everybody see what I'm doing there? All right. And Alec, I know you do it differently. I don't quite.
I did it your way.
Yeah, I think my way's safer because I think it's,
Exact same method.
well, it will give you the same answer because of the way I said it in the problem. But if I were to change, if this is the swap, I mean, if this is the swap, because that's the market. It ignores who AAA and triple B is. But if AAA instead was treasuries plus 5, I don't think you get the same answer. Right? So that's what I'm saying. So it gives you the same answer because I've rigged it to do that. But anyway, all right. And then SOFR is what you always do on the other side. Triple B, they have the comparative advantage on floating, so they're going to go out and borrow SOFRs plus 70. Plus S plus 70. And then the swap, they're going to receive SOFR, and they're going to pay treasuries, and they're going to pay 90. If I did it right. So the ultimate, so the T's cancel out. 10 minus 90 is minus 80. So S minus 80. You know off the top of your head, it's what the answer is going to be, right? Because 240 minus 60 is 180 divided by 2 is 90. So this should be 90 lower, T minus 90, which is, I mean, T plus 10 minus 90. So T minus 80 looks correct there. Over here, the S's cancel out. So you got T plus 160. Is that 250 minus 90 is 160? So it looks like that right works as well. Any questions on that? That's the most involved part. I have some students that just leave that part blank. You don't want to do that. Swaps are really, really important. They're massive. Currency swaps and interest rate swaps are massive, just trillions and trillions and trillions of notional amount. If you look online at derivatives, I mean, it's like 6 times the value of the entire net worth of the entire world. I mean, it's notional amount, so it's not a real number, but it's massive, massive numbers. And it's a little bit scary because the Federal Reserve doesn't know who has all that stuff. Trillions of dollars all over the place, and who knows who has what. So extremely important. Swaps are important. Futures are important. Options are important, but the big money is in swaps. People prefer swaps. I prefer swaps because you can really, really set up exactly what you want. It makes it much more flexible than futures. So any questions on that one? Feels good on that. How many got that? Well, I hate to put pressure on. All right, so at least a few of y'all got it right, so that's good. All right, so which side of the transaction should they be on? Triple B to go. Here's how I would answer it: from floating to fixed, and thus increasing. What do I say? Duration of liabilities. Don't say liabilities. And decreasing duration net worth. All right, that's the full answer. I say it says fully explain your answer, but that's fully explaining it. If you started off floating in a fixed, the duration of your liabilities increase. We're focused on the liability side with this swap. It doesn't have to be. I'll show you on a pension plan, we go to the asset side, but it's the thought process is the same. Am I increasing my duration of my liabilities, or am I increasing my duration of my liabilities and my assets? Questions on that one? Now, if their duration net worth had been -8, you would have been on AAA side. Because then they would have started fixed, ended floating to reduce the duration of liabilities, but here the duration is too high. All right, dollar duration gap analysis. So we have dollar in assets times the duration of assets minus dollar in liabilities times the duration of liabilities. That equals assets were 1,000. Now be careful here. We had assets of cash at 0 duration and loans at 900 with 4-year. But here your duration of assets is 3.6. That's the full 1 billion times 3.6 minus, was it 850 times, I can't remember, 3, I think. So I don't know what that is, but what did y'all get? How much? 1050?
Yeah. No.
Well, the stuff, what did y'all get?
Yeah.
Plus 1,000 times 3.6 minus 850 times 3. Yeah, I get 1050. Anybody else get 1050? Okay. So again, I ignore if it's a positive or negative number. You can just say the absolute value. So how much swap do they want? It's going to be 1050. They had a 5-year duration. So here was it 210 or something? How much? 210. I don't know, it seems too simple, but that's exactly what we did at USAA. And what swap you have? I'll get this 10-year swap, looks really good. Okay, I need a 105. Right, this 5-year, I'll need 210. It's really that simple. And in one phone call, you manage a tremendous amount of risk. Think about trying to do that with your loans or with your deposits. I mean, it would just be crazy. You have to retrain all your sales force. In one phone call, you can do this. Do y'all see why Silicon Valley was? I mean, it's just so elementary what they messed up on. They had a problem that was so easy to fix. I mean, they caused it themselves by going out so long on the asset side, but it was an easy problem to fix. So, all right. And then the last one is this true arbitrage. So we say it's magic. The true arbitrage, it's not truly arbitrage. It's not risk-free. So what is risk-free? What is arbitrage? Arbitrage is when you get more than the risk-free return without any risk. It would be buying a treasury security with an 8.4% return. Or another way to think about it is you get a positive return with no cash out. So you spend 0 today and you make $100 or $1 million, $1 billion. So that's arbitrage. It can either be above risk-free return with no risk, or it's going to be any dollar return with a 0 upfront investment. That's guaranteed. It has to be guaranteed. So it's not truly risk-free, as we are reducing one risk. What risk are we reducing? Interest rate risk or price risk, but picking up a new risk called counterparty risk. I'll let you define that yourselves. You can look that up. You know, counterparty risk is not, it's credit risk. It's a type of credit risk, but it's a little different in that how much you owe and how much they owe changes every single day. But even when you owe them money, you still have exposure because rates could change pretty quickly. So it's kind of an involved answer. I'll let y'all do that. That's one where I kind of see who wants to put in the most effort on that one. I don't know what happens if you Google counterparty risk, a lot of stuff will come up. Probably pretty good stuff. So that's not like the credit risk definition. That's not pretty that involved. I don't use counterparty risk if I'm loaning someone money. That to me is credit risk. Some people might use counterparty risk, but to me a counterparty is, you know, you both have obligations. It's the Investopedia, they can sometimes have it's a risk. I hate these things that come up. Go away. The risk associated with the other party to a financial contract not meeting its obligations, that's credit risk. every derivative trade needs a party to take the opposite side. Credit default swaps, counterparty risk, gain visibility. Yeah, so they definitely show that it's related to the derivatives market. Not everybody has counterparty risk in the sense we're talking here with interest rate swaps. If you're doing options, not both parties have an exposure. You know, counterparty risk is both sides can switch. If I buy a put option, the most I can lose is what I pay for the put option. There's not true if I'm in the money, they owe me money, but there's no way I'm going to owe them money. I've done everything I need to do. So that to me is not counterparty risk. Counterparty risk is when one party's going to owe the other. We don't know which. It can switch at any time. It can switch overnight. That's how I use it. I don't know if that's officially the right definition, but I just know in my field, anytime you hear counterparty risk, you're talking futures, forwards, swaps. You're not talking options. It's that world where things switch either direction. All right. So how do y'all feel on this? I'll put this out there. I was going to say Blackboard, but I put it on Canvas. If you can remember this in an interview, this is like really good stuff to know. It helps explain a lot of what banks do in a really simple problem. All right. So we're going to switch gears. We're going to talk about this question. And if you read my blog, you probably have it all figured out, but we'll go through it here again. I always, I get calls a lot to speak at conferences, and I send them like 10 presentations. I always send them this one because I love talking about this one. They never ask for this one. So it's like, come on, this is an interesting conversation. But I think I did this one at UTSA, but not too many people asked for it. I would love to do it at AT&T. Hopefully they'll ask me one of these days. That'd be fun. Oh, yeah. All right. So will the value of a firm, or the value of anyone doing this increase if you borrow at 3% and invest in a well-diversified stock portfolio with an expected return of 8%? That sounds pretty good, doesn't it? We don't have the word risk in there. Which of these is risk-free? You borrow money at 3%, that's risk-free. I tell people if you have a debt, let's say you borrow money on a car, on a house, and your interest rate is 6%. If you pay off that debt early, you just made 6%, risk-free. That's one of your best investments. So if you got a mortgage at 8%, you can refinance it, but if you pay off the mortgage, you're making 8%. If you have a credit card charging 18%, you pay off their credit card, you just made 18% risk-free. So if someone has a $10,000 credit card that's charging 18% and they can buy treasuries at 4%, what should they do? They can risk-free at 4% or risk-free at 18%. What would you as a finance major suggest they do? I would pay off the credit card. Why invest in that's risk-free? I hate people say, hey, don't pay off that 5% debt, put it in the stock market because you make 8%. Are those the same thing? The 5% is risk-free. So paying off debt is risk-free. That's a sure thing. There's no debt. There's no question on that. So this is given. This is set. This is an expected return. You notice I didn't say borrows at an expected rate of 3%. You borrow 3%. You know that up front. There's no risk that's given. The 8% is an expected return with a distribution around it. So I'm applying this to a pension plan, which gets a little tricky, but is a pension plan debt. And my argument is you could pay your employees today, but instead of paying them today, you're going to pay them a pension when they retire. That sounds like debt. It does have an interest rate. It's a little bit different type of interest rate here. We'll talk about it a little bit, but it essentially has a very similar different interest rate to someone borrowing money. So how do we get into this? And why I love this question so much is it draws so much of finance into one question. And it's a question you should be able to handle as a finance major, but I'm asking it kind of a strange ways. So could you actually draw on all the stuff you've done in finance and bring it into this question? Obviously, it's not an obvious answer because most of the finance world disagrees with me on this. Not all of it. I'll show you who's on my side of this argument, but most of the world disagrees. So what does debt do to risk? Borrowing money does what to company? Makes it riskier, right? Its cost of capital is going to be impacted. Its cost of equity is definitely going to go up. Its cost of capital kind of depends on the tax benefit of the debt. But one thing in this question that's really important is a pension liability is not normal debt. When you go out and borrow money at 5 years, that's debt. But when you go out and borrow money with a pension plan, you're doing something really, really different. And well, I'll explain what that is. You've already seen balance sheet immunization. We'll talk about it with the pension plan and what that does, and then see what this means for the value of the firm. I'll give you one of my favorite quotes from my first boss's boss in finance spoke to this class. I haven't asked him back because he came from the utility industry and he didn't realize how much jargon he was using. So the class was like, I don't hear anything he said. It was pretty complex, pretty advanced. He went to a farm in California right in the middle of the utility deregulation. And so it was all on his mind. He was just throwing out acronym after acronym. But one thing he said that was very understandable and I took and I've always used is he said, how do you improve the value of the firm? And he said, there's 2 ways to do it. You remember reading that in the blog? What are the 2 ways you increase the value of the firm? You increase free cash flow or you reduce WACC. Is borrowing money and put it in the stock market, does that increase free cash flow? Does it reduce WACC? That's the question. If it doesn't do those, then you're not increasing the value of the firm. So you increase the firm's free cash flow. How do you increase free cash flow? You do projects with positive net present values. You remember that? See how every single class that you can finance is coming in here. WACC, CAPM, net present value. So you increase the free cash flow of a firm by doing projects with positive net present values. How do you reduce WACC? Well, I'm going to argue balance sheet immunization reduces WACC. All right, so we're going to bring all this stuff together. Why does almost every pension plan in the United States disagree with me? Is it possible I could be right and they could all be wrong? It's possible, right? There's a chance. So you have to give me that. And my argument for why I might be right is the horrible state of pension plans in the United States today versus a liability that looks just like a pension plan that is doing great today because they do what I'm recommending. So that's my strong argument. There are people doing what I'm doing that aren't pension plans that are doing great, and yet pension plans that are doing what I say you shouldn't do are in horrible financial conditions. So that's kind of my argument. Can you apply what we're talking about here to you as an individual? Because you have a pension plan. It's called your retirement. You've got to fund your retirement after you retire. So that's a huge liability you have. Does this apply to you? And it almost applies to you, except for you have one asset corporations don't have that changes the entire dynamics. All right. So we got a lot to go through here. So let's talk about financial leverage and risk. So what are you borrowing? What is the debt? What's the liability? And what are you going to do with those funds that you borrow? Right. Normally a firm will borrow and put it into a project that has a positive net present value. All right. Here, that's not what we're doing. We're borrowing money and we're putting it into the stock market. The firm is doing something that its stockholders could do. Right? The stockholders go out and borrow money and put it in the stock market. Do the stockholders instead want the management of the firm they're invested in to borrow money and put it in the stock market? What's the advantage to the stockholder of them doing that? So that's what we're trying to figure out here. So the funds they're getting from the debt, they're not investing back into the firm at positive net present value projects. They're investing it in the stock market. I'm going to ask the question: if you take $100,000 and stick it into the stock market, what is the net present value of that investment? Anybody remember that from the blog? It's 0, right? Why is it 0? Well, we have to remind them. Remind us of those formulas. So CAPM is real important. You're probably sick and tired of CAPM, aren't you? Every single finance class. Have you had a finance? Well, probably John Dewey's class, right? He probably hasn't taught CAPM. But every single finance class other than fixed income, you've taught CAPM. What is CAPM? It gives you the discount rate for the equity of a firm. It's looking just at systematic risk. So if you borrow money, you put a project into the firm, invest in a project in a firm, it's got a lot of unsystematic risk, but your discount rate that you're using is only the systematic risk. If you borrow money and stick it into the stock market, what kind of risk do you have? Nothing but systematic risk. You're just buying systematic risk. So the cost of capital of the firm is the weight of debt times the cost of debt plus the weight of equity times the equity. I'm ignoring taxes here mainly because pension plans are a little squirrely on taxes. And KE, y'all know this stuff, risk-free rate plus beta times the market risk premium. Beta is a measure of systemic risk, not company-specific risk. What's the beta if you borrow $100,000 and stick it into the stock market? What's the beta you use to value the 100,000 investment in the stock market? It's going to be 1. All right. So your discount rate is going to be the same as your expected return. In that case, your net present value is going to be 0. You can get paid exactly to cover your risks. We'll see that. So if you borrow money and stick in the stock market, that's a pure beta bet. You're just buying beta. There's no diversification benefit. There's no unsystematic risk. You're just buying beta. You're not using expand existing operations. However, and this is really, really key, pension liabilities are not normal debt. All right? Pension liabilities are like debt on steroids. It's just an incredibly exaggerated debt. It's a debt that's extremely sensitive to economic factors. I don't know if you could actually say this, but you might be able to say pension liabilities have an exaggerated beta. They're extremely sensitive. Why? They have very long durations. So when interest rates fall, the liability jumps a bunch. When do interest rates usually fall?
During a negative economic.
Yeah, during a recession, right? How many corporations want a liability that shoots up dramatically during a recession? Does that sound like a good thing for you? It's like, hey man, we're having a tough year this year. Oh, no problem. We got this liability is at 48%. Like, wait, I don't think you heard the first part what I said. That doesn't sound good, right? That's horrible. So pension plans are terrible, very, very long duration. Not only that, most pension plans have a cost of living adjustment. So they're very sensitive to inflation. So this is an extremely horrible liability. Does terribly in 2020, although pension plans actually did decently in 2022 because interest rates rose. So the interest rate rise more than offset the higher inflation. But they're terrible liabilities. I'm talking duration, I mean, you won't believe it. I'm talking durations like 18, 19, 20 years. So if interest rates fall 1%, what is that liability going to do? It'll go up 20%. Right? They're horrible, horrible liabilities. Unless you immunize the risk. So the very existence of a pension plan is going to increase the firm's beta. All right, so just the fact that you're doing a pension plan, the fact that AT&T has these massive pension plans, just that very fact makes them a higher beta company. They have a liability that is going to be very sensitive to interest rates and very sensitive to inflation. So if you invest in AT&T, you're picking up this pension plan that makes you much more exposed to systematic events. Everybody understand that? So the liability rises dramatically when rates fall during a recession. I won't talk about taxes. Pension plans are so convoluted. The accounting rules for pension plans have changed pretty dramatically. I think to the better. They're much better now. They used to be just really convoluted. The IRS is really strange on pension plans. There's a lot of pension plans that are materially underfunded. They don't have enough money to pay their promises, but that's because the IRS won't let them put more money into it. So the IRS rules are really strict. You know, you might want to put $100 million in your pension plan. The IRS says that you can't yet. And you're like, but I need to. And it's like, if you can't, it's not allowed. So the tax rules are really, really bizarre. That's a different presentation, but I actually think that tax side of this actually strengthens my argument, but I'll leave that for another time. All right, so cost benefit analysis assess whether a project adds value by discounting all the future cash flows at a rate that reflects the risk of that project. If the discounted benefits exceed the project's costs, you have a positive net present value. then the project will cause the value of the firm to go up. Y'all had that, what, probably in your very first finance class, didn't you? I know Colin did, whoever else took my 3013 class, we did net present value in there, team project, the only place I do team projects. So yep, how many net present values have you done? You do a bunch of them, right? It's pretty common, so you know that. If it does have a positive net present value, then you shouldn't do the project because it's going to reduce the value of the firm. When a firm invests its pension investment portfolio in stocks, the net present value of that investment is zero. All right, so they have this liability that's making the firm's beta go up because it's a very sensitive liability to the economy. So the very fact that they set up a pension plan makes their risk go up. They take that money, they stick into a project that has a zero net present value. So what have they done to the value of their firm? They reduce it. So they had a liability, increases their beta, makes the value of the firm go down, and they took all of that money, and instead of just paying their employees, they stuck it in the stock market. It has a zero net present value. Y'all see why the stock market has a zero net present value? Your discount rate exactly reflects the risk of the stock market. When you do that, you're going to get, now you might say, well, but I think the stock market's undervalued. How often are people right on that? Not too often. All right, so is it possible? My argument against that is if you take a firm like AT&T or UPS or these that have these big pension plans, it's not like they're 20% stock one year and 70% stocks the next. They're just 70% stocks all the time. So that argument, it's not like they're moving out of stocks based on how valued they are. And I don't think they would get it right anyway. So the net present value of investing in the stock market is zero. That's true when you invest as well. When you invest in the stock market, your net present value is zero. It doesn't mean you shouldn't do it. It just means you invested at 8% and you needed 8% to cover your risk, so you got exactly what you deserved. There wasn't any arbitrage, any extra benefit to that. So the beta is 1, so it's pretty obvious. The beta, you don't use the WACC to value this because you're not investing in the firm. You're investing in the stock market. The discount rate for investing in the stock market is the risk-free rate plus 1 times the market risk premium, because the beta is 1, all right? That's why it's important where they're putting this money. If you invest it in the firm, then you use the WACC, because you're investing in the firm. It reflects the risk of the firm. Most pension plans invest in actively managed stock portfolios. What's the net present value when you do active management? It's probably negative, because we know 90% of active managers underperform the market. So most people are probably, and trust me, I've seen this my whole career. My department, we went indexed on all of our stock portfolios in our 401k plan and in our pension plan. And my staff would go to conferences and they come back and say, yeah, the whole table was complaining about all their horrible managers. And we're just sitting there going, yeah, we don't have to worry with that. We don't do that. It's no one's good at it, and everybody thinks they're good at it, but trust me, no one is good at it. It's so hard to pick good managers. I learned it when we were interviewing a consulting firm to come in and bring us these good managers. So we interviewed all the largest consulting firms in the United States. That all they do is go and find you active managers to beat the market. And my question on the request for proposal was, once you recommend managers, what is their performance going forward? And every single one of them, their answer was 50%. They said, our recommendations are as good as darts at a dartboard. Our managers are just as likely to outperform as to underperform. How much would you pay a consultant for that? You can hire a consultant or you can get a dartboard. Which would you rather? A dartboard would be a lot more fun, right? You put all the managers up, you just throw darts. So why don't you use Morningstar stars, right? Our 5-star funds. How do 5-star funds do? No better than 2-star funds. They have done well. That's why they got 5 stars. We're talking about going forward. 5-star funds don't do any better than 2-star funds. So we're not good at picking managers. So your best bet is just go index, which is what we did at UTSA. We'll talk a little bit more about this when we talk about the Robert Arnott article. But yeah, I mean, it's before we went index, we're spending 98% of our time picking managers. once we went index, that workload went away. It was a waste of time of workload because you never won that battle anyway. So bottom line, when firms offer a pension plan, the very fact that they have a pension plan increases their WAC dramatically because the pension plans are so unique. They're so risky. And then when they stick that into the stock market, they have a net present value of 0. They've essentially just crushed the value of their firm. So let's talk about pension liability and why it's so risky. So anybody remember the 4 risks of a pension plan from the blog? So you tell someone, I'm going to pay you, once you retire, I'm going to pay you $4,000 a month until you die plus inflation. So what kind of risk are you hearing in there? What could go wrong? They live to 150. Inflation takes off. Those are 2 of them. What you can think of the other 2? Interest rates fall. Yeah, so definitely. And then there's one last one. Very good, Harm. Yeah. So longevity risk, that's the risk that they live too long. How do you manage that risk? Most pension plans just hope for the best. You can hire a hitman and all that kind of stuff. Most of that's illegal, so you can't just kill your former employees. There's an actuary at USAA who came and talked to me. So USAA offers life insurance to all of his employees, and USAA was insuring that. So they were worried about their employees dying too soon. And I had a product where I was worried about them living too long. And he says, hey, could we hedge each other? If our employees die too fast, you pay us. If they live too long, we pay you. I said, that's interesting. The problem is they're not the same employees. You're insuring active employees. I'm insuring retired employees. I'm not so sure that's going to line up very well. But it was an interesting conversation, right? It'd be hard for the same employee to both die early and live too long. That would be pretty tough. The problem was it wasn't the same employee. It was a different group of employees. Longevity risk is a tough one. We really don't know what this is going to do to, like in the United States. You got Medicare, you got Social Security. People start living, is it Elon Musk who's out there looking for the fountain of youth? And there's people who think, the human body shouldn't die. It's killing itself. And they're trying to figure out what it is that's killing itself. I mean, it's pretty amazing. There's no reason for the human body to die at 80, 90 years old. If you don't believe me, I think the oldest woman to have a baby was, 60 something? Think about that. A 6-year-old woman produced a brand new human body. Our bodies are more than capable of regenerating, whatever the word is, right? If a 6-year-old woman can produce a brand new human, our body can keep us young, but our bodies are killing. So what happens if Musk discovers a way to make us live to 170, 180, 190? What happens to Social Security? What happens to Medicare? You're not going to be retiring at 70, are you? You're retiring at 120. So I'm going to take early retirement at 110. It's going to change everything. It's going to be pretty amazing. We don't know how to manage this risk. It's pretty tough. Medicare would be an absolute disaster. So, it was kind of funny. This anti-tobacco group hired a consultant to prove how expensive tobacco was to the federal government. And yeah, I tell you all this story. And so they did the study and they discovered that tobacco was helping the US government because it was killing so many people. It was saving Medicare and Social Security money. And they didn't like the result of that study. But yeah, people living a long time is a huge expense to governments. And we don't have a really good way to manage that risk. What time is it? This 8:41. All right. So let's finish up. Anti-selection risk. Healthy people are likely to take a pension. Unhealthy people will take the lump sum out early. That's what I did. I took the lump sum not because I'm unhealthy, but because I had more than enough retirement that I didn't need my retirement from USA, so I took it out. But if someone was really unhealthy, take your money, and you can lump sum this. You only get the lump sum once. This isn't a multiple choice. I did it when interest rates are really low because the liability is really high. So I'm glad I did it when I did it because rates have risen a lot since then. But unhealthy people, yeah, there's no reason to take the pension plan. You might as well just take the cash out. But healthy people, USA's pension plan was wonderful. This one lady, I remember after she retired, she lump summed and then she emailed me, where can I find a good annuity? I said, well, you had it. you could not have done better with the annuity you had at USAA, so you should have just left it there. But she took her money out. That option was gone from her. Inflation's a risk at USAA. They covered inflation up to 10%, which is a pretty good number. So this last year, they were paying a pretty good, or 2022, they were paying a pretty hefty increase. I don't think Social Security is capped at all. So if inflation goes up, Social Security is going to pay their higher amount. I noticed it in my mom's Social Security. And then just interest rate risk. Interest rates fall, the liability is going to shoot up quite dramatically. You have some of these risks as well. We'll talk about that when we talk about you personally. All right, well, let's continue it here. Oh, there's people living longer. There's Whistler's mother, 67. There's Sophia Loren, at whatever age she was, 77. Have y'all noticed pictures back of people like in the 40s and 50s? And go look at that 70-year-old man, and you say, "Oh, he's 52." I mean, I know I look 87, but most people are living a lot longer and looking a lot better. All right, we'll start after that. All right, so we talked about these 4 risks that you have. We'll talk about what these are specific to you as an individual a little bit later. So pension plans, for GAAP accounting, the rules have changed dramatically, but they've changed dramatically, I think, a lot better. Not everybody agrees with them, but they have changed for a lot better. But I don't think they're perfect yet. Sorry. I don't think they're perfect yet. What discounts should you use? So we're talking about discounting a liability. And it's a very risky liability, but it's a liability. You know, when you discount an asset and it's risky, you use a higher discount rate. When you're discounting a liability and it's really risky, you should use a lower discount rate. Does that make sense? You're conservative on the asset side, higher discount rate. But if you're uncertain on liability, you use a higher discount rate because it's much more risky. And so what should the discount rate? Well, the discount rate they use is the current yield for investment grade corporate bonds. That's a pretty high number. That's the reason why a lot of pension plans in 2008 actually saw their liabilities fall. They lost a lot of money on the stocks, so they lost a lot of their surplus, or all of their surplus, but they're using a discount rate that was pretty high in 2008. I think they should use treasury rates because it's a very risky, so if it's really risky liability, use the risk-free interest rate. Public pension plans, it's even worse. They don't use bond yields, they use the expected return on assets. And remember, they're 60-70% in stocks. They're using discount rates like 8.5%. So when the state of California says they got $50, $100, $200 billion in unfunded pension liabilities, multiply that by 3 or 4 because they're using the wrong discount rate. It's a really overstated discount rate, grossly understated liability. There used to be a website I could show you, and they took their website down, that showed you everybody's pension plan, especially California's pension plans, and you could change the discount rate to the treasury and you'd see that thing zoom, just a massive number, and it's pretty scary stuff. How do you fix that? The state of Illinois, I don't think it's possible. I don't think there is a solution other than telling retirees you're not going to get as much as we promised, and that creates huge strikes and people, protests. Don't touch my pension. So essentially what politicians have said is, let's just kick the can down the road. And that's the solution to everybody, because it's not an immediate problem, it's a long-term problem. So let's kick the can down the road and we'll worry about it later. If I were a political cartoonist, that would be my cartoon. I'd have a bunch of politicians kicking cans, and at the end of the road there's this 18,000 foot tall pile of cans, because that's what we're doing. Just kick the can down the road because it's going to blow up, but not while I'm in office. And we just keep doing that. So this is a huge issue. You're seeing it play out in Japan probably a decade before the US, and they're having serious problems. If anytime, what happens in France when they mention pension plans? Right. They turn cars over, they set them on fire. And that's what we're talking about. We're going to change retirement from 65 to 62, 62 to 65. I mean, it's not that massive of change, but people go wild. So there's no real good solution for any of these countries. Eventually, you're going to have to just tell people to retire later, or you're going to have to pay them less. There is no financial solution to this. So we've got a serious problem, and the serious problem is grossly understated because we're discounting it at too high of a rate.
So it's a huge issue in the United States. So pension plans have very, very long durations. So when rates fall, the pension liability increases significantly. When rates rise, it falls, but it's not symmetrical. All right. So it has positive convexity. You don't want you like positive convexity on bonds on the asset side. So when rates fall, you make a whole lot. When they rise, you lose, but not as much. Pensions, it's a liability. So when rates fall, it rises a bunch. When rates rise, it falls, but not as much. It's disproportionate. You'll see those numbers when we do the nght article. So it has significant positive convexity. It's really quite skewed. That's bad. We'll talk about life insurance companies. They have the same issue. They have liabilities that are very positively convex. It's hard to find assets that have that much positive convexity. So this is another significant issue for pension liabilities. Well, I'll show you the actual numbers and you can calculate themselves. Well, here's actually the number. We'll get into that. That's too blurry. I'll show it to you in the article when we do the nght article. So what's the solution? So you increase the value of a firm by either increasing free cash flows, which is positive net present value projects. Pension plans aren't doing that because they're investing in stocks, which has a net present value of what? 0 or negative. So they're not doing that. So how can you add value? Well, you can add value by reducing risk, reducing your cost of capital. How would you do that? Balance sheet immunization. That's the way you do it. So life insurance actuaries. So here's how I figured out when I inherited USA's pension plan. I had this pension plan at 70% stocks. So I go talk to John, my life actuary friend. Okay, John, you manage life insurance liabilities. I manage a pension plan liabilities. Our liabilities look almost identical. You're 100% bonds. I'm 70% stocks. What gives? Why were you so different? And John was pretty brutally honest guy, and he just said, "You guys are stupid. You're idiots. You don't know what you're doing." He was pretty negative on it, and I think life actuaries have this view of you pension people, just you need more actuaries, you don't know what you're doing. So he's pretty negative on the view on this industry. I have a lot of respect for John because he's a really smart guy. So I didn't go, oh, he's right, we got to change what we're doing. But he got me thinking, should our balance sheet on the pension plan look more like the life insurance side? So similar liabilities, very different investment strategies. Life insurance companies are not shutting down today. Pension plans have been shutting down for a decade or more. So I think John has a better argument that his approach has more longevity to it and it survives, and pension plans are throwing in the towel and giving up. So my opinion is, if pension plans have been managed the way life insurance companies have been managed, we've had just as many pension plans today. You would all have a nice pension plan at your company. It would all make sense. But because we bet on the stock market, we're now having to shut these plans down. So the way you do balance sheet immunization, you start with the liabilities, figure out what drives them, and you buy assets that manage that risk. That's what you as an individual should do. Like I said, you have a pension liability too. Does that mean you should be 100% stocks? No, because you have an asset pension plans don't have. That changes this whole equation. Anybody remember what that asset is? I've taken my life insurance class.
Human capital.
Huh?
Human capital.
Human capital, right. You got human capital that radically changes everything. So we'll talk about that as an individual. So you have those 4 liabilities: risk, longevity, lump sum risk, interest rates, inflation. Of those, I'm not going to say interest rate is the biggest, but it's the one that's the easiest to manage, and it's the one that causes the most volatility. There's really no good hedges for longevity risk or anti-selection risk. There are hedges for inflation risk, but it's not in the size that you really need. If you think about a swap, interest rate swaps, we swap floating for fixed, and in inflation swaps, you pay SOFR and you receive inflation. You worry about inflation rising. The other side about that transaction has to be someone who's worried about inflation falling. There are not enough people like that. Like, man, I'm worried things are going to get cheaper. There's a few, like governments may be in that camp, but most people are more worried about prices rising than falling. So you don't get a really good hedge there. For a hedge to work, you have to have people on both sides of the transaction that have a risk to manage. You can't just have speculators on one side. So interest rate swaps work really well. You have people on both sides who need to do that swap, but inflation doesn't work. So there are CPI swaps, there are sweet CPI, other type of derivatives. There's just not much volume. I know at UTSA we had someone come in and talk about CPI swaps. We got real excited because inflation was a big deal. And then he told us how much notional we could get. And it's like, yeah, we don't need millions, we need billions. That's just not enough. So, so hedging interest rate risk. So your portfolio needs long duration bonds to offset that liability when rates fall. And those bonds need to have significant positive convexity. The capital market does not have those bonds. Corporations don't borrow at 30 years. The Treasury does, but you can't really do a lot of treasuries like that.
So you decided not to take the counterparty risk, even though it'd be would it just not mitigated enough for you to even like?
You're talking about on CPI?
Yeah.
No, there just wasn't enough volume. There wasn't another side. He was saying, we might be able to do 5-10 million for you. We're like, we got 20 billion. It's like there just
So
wasn't.
this wouldn't have been worth your time even to mitigate that a little bit.
Well, not that little bit, no. There's a great book, I wish I could find it because I highly recommend it, but it's a guy who, his career was creating these derivatives, and chapter after chapter is the lessons he learned. And one of the biggest lessons for a derivative to work, you have to have risk managers on both sides of the transaction. If all you have is risk managers versus speculators, it's just not gonna work. The speculators will do all right, but the risk managers have way too much and they just overwhelm the market. So capital markets don't have 18-year, 19-year duration bonds. So how do you handle that? Interest rate swaps, dollar duration. So swaps is an easy way to pick up duration that the markets can provide you very, very easily, as you've already seen, right? So you can't do it just with bonds. You have to do bonds plus swaps. You're just not going to get enough interest rate coverage with just the corporate bonds. You should have a lot in corporate bonds. We'll talk about that. All right, so what should pension plans do versus the law? What does the law say? Federal law says all decisions that pension plan fiduciaries make must be solely in the best interest of plan participants. We had this debate at UTSA. So I immunized UTSA's pension plan. I was talking to my lawyer. Said, well, what if I didn't immunize it? What if we stay in 70% stocks and the stock market does well? It makes the pension plan cheaper, so that makes us more likely to be able to offer a pension plan. And he said, no, that's not good enough. So let's think about it. You put 70% in stocks and the stock market takes off. What's the benefit to the pension plan participant? Nothing. They get nothing, right? Because their pension is defined by contract. They get 2x whatever, how many years they work. So a really great stock market, the pension participant gets no benefit. You don't say, hey, the stock market's done well, we're going to increase your pension plan 20%. No one ever does it. The stock market crashes. What happens to the pension participant? They may lose their entire benefit. They get hurt. So they get no benefit on the upside. They take all the risk on the downside. Does that sound like something in the sole interest of the participant? Doesn't work at all. This is a fiduciary responsibility. So it actually says the best thing you can do for participants is give them the highest probability you can pay their pension benefits. What is that called? That's called balance sheet immunization. You get the highest probability you can pay them by making sure you immunize the balance sheet. The liabilities should be hedged by the plan assets. There's no benefit to plan participants. My argument that their benefit is we're more likely to keep offering the plan is like, no, it has to be current plan participants. They've already earned their benefits. Tell them that we're going to gamble on your assets because we might be able to, continue this plan for an extra 5 years. That he said that couldn't be a good argument. Not only that, but if the pension plan investment stocks and stock market crashes and the pension plan can't make its requirements, that pension plan now goes to the U.S. taxpayer and they pick it up. Now the participants may get 70, 80 cents on the dollar, they're probably going to lose some of their participant plan, but the U.S. taxpayer is going to pick that up through the Pension Benefit Guaranty Corporation. So it's kind of what stockholders are saying is, hey, if the stock market goes well, we win. If it messes up, the plan participant and the taxpayer takes it. So, you know, why not gamble with this? I still don't think it's in the best interest of stockholders, but that's somewhat of the debate that they're making. So I believe, this is Ron Sweet, that firms that put a lot of their pension plan in the stock market are violating their fiduciary responsibility to participants. Their number one goal is to maximize the probability the plan will make its commitments to its participants. And that's what balance sheet immunization does. I used to bring up the fiduciary responsibility because it works pretty well, because the people I was working with, they had personal liability. If we made a decision for the pension plan and it didn't work, we could be sued by all those pension participants. My insurance was $25 million on a $3 billion pension plan. I was like, I don't think that's enough. I need $3 billion for a $3 billion pension plan. So 25 million sounds like a lot, but it's not a lot, or a pension plan could fall, you know, several $100 million. Questions on that? What's the difference? I mean, what fiduciary responsibility is, you got to put other people's interests above your own. Your decision, and that phrase, solely in the interest of, I think is a pretty powerful statement. So what does balance sheet immunization do to the value of the firm? So you increase the value of the firm by increasing free cash flows or reducing risk. Buying investments in a pension plan to hedge out the interest rate risk of the pension plan reduces the firm's risk and increases the firm value. Okay. So real key in this part of the discussion is the net present value investing in the stock market is zero. You're getting paid for your risk. The net present value in investing in the bond market is zero. But investing in the bond market reduces your risk. So there's zero free cash flow, but lower risk, you increase the value of the firm. The stockholders are better off if you put the plan participants first, because you're reducing the risk of the firm. And that's true. I mean, you have a pension plan that's in the stock market, you're making your firm much more sensitive to beta risk, to the stock market gyrations. You're just giving your stockholders higher systematic risk. All right, so we've already talked about this. Everything you're investing in has a net present value of zero. You're getting paid exactly for your risk. So the goal of balance sheet immunization is to reduce risk. When my corporate treasurer spoke to this class, he's the one who brought these two up. You increase free cash flows by doing positive net present value projects or reduce risk. And he says most managements forget the second one. They're so focused on the first one, they forget that they can increase value by just reducing firm risk. And this is tremendous risk reduction. Why? Because that pension plan is so sensitive to interest rates. It's just very, very noticeable. There's a lot of firms that pension plan, boy, it just really, the stockholders notice it. So balance sheet immunization is going to reduce the cost of capital, increase firm value. So why do pension plans do what they do? That's kind of what John, the actuary, is like, why you guys do like what you do. So inertia is a big part of it. I don't know the history of when pension plans started investing in stocks, when you had the life insurance industry that had been doing it another way all along, and very, very similar product. You think they would have looked at each other's business and learned. So financial theory, and I think practicality, strongly argues against a high allocation to stocks. Well, part of it's accounting. So I blame a lot of stuff on accountants. GAAP accounting masked a lot of this volatility of pension plans by spreading it out over like 40 years. So the stock market might be going like this, but because pension accounting was so complicated and because the accounting spread things out, the stockholders weren't really noticing it. So guess what they did? They changed the accounting, and now when the stock market moves or interest rates move, all of that goes through net income. So now the stockholders are noticing this, so what did managements do? They shut down their pension plans. Rather than hedging it and making it right, they just shut the plans down. So Historical accounting, and I can't remember when this changed. I was at a conference right after it changed. I think I told you the GM CEO or CFO was just cussing about it because GM has a massive pension plan. It caused tremendous volatility to their accounting. So when it changed, essentially all of the stock market interest rate changes goes right through net income as they happen. A massive, massive impact. The other reason why they did it is you had the high stock returns of the 1990s, and so they're like, wow, it's working, we're making money, this is great. And then you had 2000 and 2008, which are kind of a surprise. But what they were missing was, yeah, the stock market was doing well, but what else was happening during this time? Interest rates were nosediving. So yeah, they're doing great on the assets, but the liabilities also shooting up. So it wasn't as great of a solution as they might have thought. So they say, wow, it worked in the 90s, it worked out well in the past, so it must be a good strategy. That's never a good strategy in finance. So, wow, Apple stock's really done well the last 40 years. I'm gonna put all my money in Apple stock. Is that anything y'all would recommend? Does that sound like a good investment strategy? Wow, look at NVIDIA stock. I should put 100% of my money in NVIDIA stock. It's done. But saying that it worked well in the past, so it's gonna work well in the future is just not a good solution. We're so used to the US stock market doing really, really great, but the US stock market is a pretty unique stock market compared to the rest of the world. You can look at Japan. Japan was a great stock market until 1989, then it sold off. It's starting to come back, but it's taken it 30 years to get back, or 40 years to get back to where it was. Other markets are just all over the place. You're seeing China blowing up now. So the US is fairly unique. The US also looks really expensive versus others. Could the US have a decade of bad returns? It could. There's no reason why it wouldn't have to. So you could argue to do anything, you just rely on the past. But the question is, what's the best strategy going forward? And so because of that, because the accounting changed on pension plans are now going away. I think it's a mistake. I think pension plans are actually a really good thing. So most pension plans discontinued their pension plans, the accounting changed, and then you had the 2000 market crash. So a lot of just bad things. So they still have a pension plan, but just for past employees. So they're not providing new benefits. So USAA, I tried so hard to keep USA's pension plan in place. I argued, we were hedging it, so most of the risk disappeared, but our CEO is like, he shut it down, and they shut down the pension plan, and they instead just greatly increased the 401k contributions. Big mistake for a lot of the employees. But because of all of this, plans were just stopped, except for state plans. Public, a lot of states still have big plans, fireman funds and all those. A lot of them have pension plans, which is blowing up their states because they're 60, 70% in stocks. So here's, I should have updated this. I have a more current one, but defined contribution plans. Another word for that is what? 401k plans. Most of y'all will have a 401k. Most of y'all will probably already have a 401k plan. And then defined benefit plans, that's the pension plan. They're dropping pretty dramatically. I have a more update one than that, but so public pension plans are still being offered. These plans still have high allocation of the stocks, and their accounting rules continue to make them not look as bad as they really, really are. So it's not. So several states are nearing insolvency. When this www.pensiontracker.org was working, it's been shut down. They said in California, their unfunded pension liabilities come to about $75,000 per household. That's how they could fix that problem. How much do you have to tax people to collect $75,000? That's in today's money, so it's going to grow over time. So it's huge. $1 trillion unfunded. That's if you use the right discount rate. It's not that high the way they officially record it because they're using a much higher discount rate. So these are massive problems. And California is not the worst. Illinois is the worst. So I believe in pension plans. Why? So it's going to sound really paternalistic, but USA has this incredible 401k plan, and it had a pension plan. So I'll give you one example. A friend of mine I helped her on her 401k plan. She helped me on my insurance. She was on the insurance side, so I let her take care of that. And I was watching her 401k plan. She should have had $500,000 in her 401k plan. She had 40,000. Why did she have 40,000? She was contributing. Why did she have 40,000? She kept taking money out for her son, for her house, everything. And I was managing her 401k, and it was like, she's like, oh no, I'm down 1%. Oh, I'm up 2%. I was like, it's 40,000 bucks. It's going to cover you like for 2 years in retirement. It's just not much money. Well, how much was her pension plan worth? Several $100,000. That was her retirement, was that USAA pension plan. Even though it was shut down, she had worked 30 something years where she was building that. So she had that, and then they shut it down, and then she got the 401k. She is not abnormal. She is quite normal. USAA offered the ability for employees to borrow against their 401k, and we're like, how many are going to do that? It might be 5-10%. And then when they started borrowing, we were shocked how many people were borrowing from their 401k like immediately and taking that money out. And they didn't quite understand it because you're not charged interest officially. I mean, you're charged interest, but you have to pay it yourself back in. So they're like, well, I'm paying myself interest, so I'm not losing anything. And what they didn't realize, if you take $100,000 out of your 401k plan and the stock market gets up 10%, how much was that loan costing you? It cost you 10% because you missed out on the stock market. But people were understanding. People were taking out, and then they let them take 2 loans, and people are taking out loans to pay off the previous loan. And I cannot remember the numbers. I just remember everybody in the room was about to faint because they're like, oh, we can't believe people are taking out. So 401k plans are leaving a lot of Americans underinsured for retirement. Just a huge amount. People are not good at 401k plans. If your company matches 8%, how much should you put in? You should put 8% in, right? That's 100% return immediately, and that's what USA was doing. We had employees, USA this massive bonus every year. So you get like this massive, $20,000 payment. People would turn off their 401k contribution for that one day, so they get the entire bonus. It's like, no, that's when you should. That's the most important day to get it. You're getting a big bonus, doubled up, but people just didn't understand it. So that's why we have so many Americans in their 50s and 60s with that $50,000 saved up for retirement. It's just, it's not going to be enough to get them through unless they die really fast. That's the other solution.
They got Social Security.
Yeah, Social Security, it's going to give them $2,000 a month, and then, my mom's Social Security is $1,800, and her assisted living $6,000 a month. So yeah, it's not enough to live on. So I believe in pension plans. I'm kind of paternalistic, but just talking to some of the employees, the pension plan they don't even notice because the company's contributing. It is their money. They might rather have it in salaries, but because it's going to pension plan. I mean, think about this lady, $40,000 and a few $100,000. She should have had several $100,000 at 401k. That's the difference in the discipline. And so it's a big problem. So what has management done? They passed all the investment requirements, understanding all that risk has been passed on to the employees to manage their 401k plan. Why do companies like 401k plans? Because it's not on their books at all. It's their employees' money, it's off the books. The pension plan's on their books. When it goes up and down, it goes through their net income. 401k plan doesn't even show up on their books. It's not a liability that they have to worry about. So most people in their 50s and 60s are not ready for retirement. They have Social Security, they have 401k plan balances that are woefully inadequate. This could be catastrophic. I've met with some people, I met with a couple just a few weeks ago. They had some money, they had maybe $160,000 saved up, and they had Social Security. He said he knew how to do Excel. I was trying to get him to put everything in Excel so he can look at it. And he's like, I don't really like it. He was like, use Excel, put it down. So it's hard for me to help him because we didn't really know what he had. We couldn't kind of do that. But he was really worried, do I have enough? I met with another couple. They didn't have enough. Their only solution was to keep working into their 70s. And he's like, yeah, but my health isn't too good. We got these 2 special needs children. They're going to be living with us the rest of their lives. And I just left depressed. I was like, there wasn't a solution for their problem. It was pretty sad. And there's people like that. Some of your parents are probably like that. Do you realize your parents' retirement plan is sitting in this room? I mean, I don't know if you've thought about it. You may be saving for retirement and for your parents' retirement, and that's where we are today. People are just not. Do y'all know what your parents' retirement situation is? Are y'all too scared to ask them, or is it good news, or is it scary? Some are probably in good. Some are probably going to leave a massive inheritance. Some are probably not.
What would you say is a good amount of money to have in 401k at 65?
At 65, well, you need $1 million just to get by with Social Security. So if you don't have $1 million, you're probably not gonna make it. I don't know.
So you need to kind of like closely like max out your 401k every year.
Well, you should definitely max out on the match, no question.
Okay.
I would max out on the tax law.
Which is like
So if your 401k, you can do the 401k with the match, and then you can contribute more.
that's like 20.
You can even contribute more, like with after-tax dollars, and get the tax deferral, or you can, So look, I can't remember what the max is on like a Roth IRA, but you have to. The 401k is going to limit your Roth, but you should max out the tax law as much as you can. So yeah, 10-15% of your income should be going into retirement, and at your age, you should be putting a lot into stocks for a very different reason than pension plans shouldn't. But yeah, it's a looming issue. Unless you want to work till 70 or 75 or whatever, it's a huge issue.
And then when you like take it out, isn't it like recommended to take it out like in partial? Not.
Well, you have to start taking it out at 70, and then they're going to tax you, and it's 100% taxable. Because the 401k goes in 100% tax-free, and then it's 100% taxable when you take it out. But if you do a Roth, it's not tax deductible, but it's tax-free. Supposedly, I don't believe that. I don't think Roths are going to be tax-free, because I think by the time your Roth matures, the government's going to be so desperate for money, they're going to start taxing your Roth. But supposedly Roths are tax-free.
For both 401ks and IRAs?
Well, 401k can be a Roth 401k.
Right.
If you do a Roth 401k, you don't get a tax deduction today. You're taxed on the money you put in, but you don't pay any tax supposedly forever.
So which one do you like better, pre or post tax?
Well, the Roth is better assuming the government doesn't change their mind. If the government changes their mind, who knows? Flip a coin, you don't know.
Wouldn't the Roth be better for us now, since, like, for example, we're not going to be making as much now as we will be in 10, 20, 30 years. So we're putting that money in now taxed, then we won't get taxed higher.
Yeah, you're lower tax rate now, and you're probably a much higher tax rate then. But that's assuming the government doesn't tax Roths 50 years from
So
now.
would you say it's
So-
safe to assume that they are gonna?
Oh, I have no doubt. I'm not. Y'all can come visit me in the nursing home and let me know. I won't even, I'll be drooling and not knowing what you're talking about. Who knows? We have a huge government deficit. That's why I say look at Japan. Japan is everything we have 10 years ahead of us, far worse. And it's a disaster, and yet Japan's still a pretty pleasant place to live. So it's not causing riots and disruption. It's a very pleasant country to live in.
What would you say about HSA plans?
You mean for healthcare?
Yeah.
Yeah, that's kind of a completely different issue. But again, take advantage of the tax law and make sure you're getting the max out of that. You should be saving as much as you can. The key to wealth is how much you save and how much you spend. So the other part of the equation is don't spend so much money. We'll talk about that when we do Kinemon. So yeah, I mean, there's a secret to wealth. I mean, I retired at 46 not because I saved so much, I did, but also because I don't spend so much. But yeah, there's a lot you can do with it. There's some people with millions that are poor because their lifestyle is just ridiculous. There's people with hundreds of thousands that are rich because their lifestyle is so simple. So the lifestyle is a big part of it as well. But is a looming crisis? How do we solve the crisis? I think our government's going to have to push retirement ages back pretty significantly. If you're going to live to be 85, think about it. When the 65 retirement age was hit, life expectancy was 65. So 50% of the people are expecting not to make it. Now life expectancy is 85. So we're like 20 years we have there. We can't do that. We're going to have to push these retirement ages back. But think about these blue collar workers. Do you think they want to work till 70, 75? And these are tough jobs. They want to get out of these things as fast. So it's a tough question. I do a lot of pro bono, and most of it just leaves me depressed because there's just not an answer. I had one couple come to me and they had millions. It's like, what do we do? And I was like, okay, this is kind of a fun problem. I was like, find a charity you like and donate it. Start giving some of it to your kids every year. It's like, It's your money, you're alive, enjoy it, it's your money. So that was a fun problem, but that was 1 out of 50. You know, most people are not prepared. So it could be catastrophic, but I don't know what that means. Japan hasn't been catastrophic yet. They seem to be getting by okay. So I like pension plans. I think they'd be still in place if they had been managed like life insurance companies. I don't think we'd be talking about this crisis today. I think Americans would be much better prepared for retirement. So instead, we face the prospect of people having to work well into their 70s. I was at a Subway a few weeks ago, and the lady that served me, she had to be in her mid-80s. Real sweet person. She's the only one there. I mean, it's pretty amazing. She was running the entire store. Do you think she's working there for the fun of it? Or because she doesn't have enough retirement? That's pretty sad, isn't it? She's working there. You almost want to do a GoFundMe, but she was really good at the job. She's, you know, it wasn't like she was at least standing on her feet all day at 80 something years old, but that's not what you want to do when you're 85. So it's scary. And I think we've done it to them by not being adequately prepared. All right, before we get to application for individuals, I want to do the article to put this in some perspective. So this presentation is somewhat based on this Robert Arnott article. I'm a big fan of Robert Arnott. You should be reading his articles, watching his YouTubes. Very, very influential person. He wrote this article. It was an editor's corner. He was the editor of the Financial Analyst Journal for a few years. The best that journal's ever been when he edited. I got to meet him at UTSA, and I was able to tell him that. I said, man, I wish you were the editor again, because that's the best that's ever been. Really nice man. I kind of thought he was kind of arrogant, but because he's so quiet, I discovered he's not arrogant. He's just really, really humble, and he's just real quiet, but he's a very personal, friendly guy. Really nice guy. As smart as he is and as important as he is, very down-to-earth, friendly guy. So just quiet. He's kind of shy. So he wrote this article. It was a little hard to read, so he wrote it as an editor, so I think he wrote it pretty quickly. He used a lot of jargon. So I took his article and rewrote it and took the jargon out and fixed it with a little bit better. So some of the jargon, he would use 4 different words that mean the same thing, and he just kept switching his jargon, but he meant the same thing, so I fixed all of that. So he's talking about these pension plans, and he's asking the question that I've already answered: can we keep our promises? And the answer is kind of no so far. But in this, he talks about 3 risks, and I add a 4th one. All right. So I want to make sure this is really, really clear. So Arnott has 4 risk for portfolio managers' pension plans. Remember, I gave you the 4 risk pension plans. That's a different thing. I'm gonna show you where that fits in this list. So what do pension plan managers worry about? And the number one thing they worry about is peer risk. Y'all know what peer risk is?
Not performing as well as your other managers.
Yeah, like other pension plans or benchmark. So another manager's up 8%, you're up 7%. That would be peer risk. You're underperformed. So that's underperform a benchmark. The second risk he talks about is asset risk. Assets lose value. And then the last risk is what we've been talking about, which is asset liability risk. Assets and liabilities move in opposite direction, causing a loss of surplus. I can't spell, I just can't type. Bill Gates should have fixed that one. That's ALM risk. I add one more that's implied in his, and that I call career risk. What is career risk? It's really closely tied to peer risk. So career risk is being unconventional and underperforming. Not being like the pack, doing something different and underperforming, that's career risk. That's when you get fired. If everyone's down 25% and you're down 25%, you're fine. If everybody's up 25% and you're up 20%, you're fired. Which would you rather do, lose 25% or make 20? I'd rather make 20. You make 20, you're fired because you should have made 25. What if everybody's down 25 and you're down 20, and the next year everybody's up 25, you're up 23? You still get fired because you didn't. That's career risk. What does career risk do? So career risk, you manage this by being like everyone else. That's another reason why pension plans are so heavy in the stocks, because every pension plan does that. That's career risk. I always tell the story of the hedge fund that came in to my office. He was so excited. Some of y'all have heard this story before, but it just still sticks in my mind because it so explains this industry. But he comes in the office and he's so happy, he got good news. I'm like, wow, I didn't think y'all did well. Okay, what did y'all do? He says, oh, it was a great year. We're down 20%. It's like, that doesn't sound like good news, but his benchmark was down 25. And he was like, we love meetings like this. It's like, he lost a fifth of my money. And I promise you, he goes, oh yeah, that. Like, away with you. You lost a fifth of my money and you think that's great news. I don't understand, but that's what career risk is about. The key is to be like everyone else so you don't get fired. You can lose money as long as everybody else is losing money. If you're making money, you better be making 20% if they're making 20. If they're making 10, that's not good. So career risk is huge. It's part of peer risk. All right, where do you think the industry focuses their attention on this list? Well, peer risk, which is part of, yeah, so this is probably 99% of their work. Where do they put the other 1%? 1%. Asset risk is once a year or so, they look at their policy and decide their asset allocation. So we'd be 70% stocks, 60%. So 1% is a little bit of a stretch because that's one meeting a year where they say, yeah, let's just keep doing what we're doing. So it's not a lot of time consumption. How much goes on asset liability risk? 0%. So that's your time commitment. Which of these is the biggest risk? The very third one, where we spend more time, no time, that's where the biggest risk is. So what are the risks of the ALM risk? And y'all think there's 4 risks of ALM risk. What do you think they are?
Your liabilities increase.
Well, interest rate risk.
Interest rate. Yeah, I've already had this list, so just give it to me again.
Oh, anti-selection.
Anti-selection. What's longevity? Y'all know this list, right? Inflation. Right, so Arnott doesn't get into details on the pension list because he only talks about one of them, and that's the inflation risk. But all 4 of them there are, he's not ignoring them because he doesn't know about them. He's ignoring them because it's a short editor's article. All right, so you see how my list of 4 fit in with his list of 3 R4. I added career risk just because I know that's how the industry works. All right, so he's going to go through this. I want to go through his article. He has a solution. I disagree with his solution, but I understand why. I'm going over the edge, and he's like staying back a little bit. And that's because he's fully aware of this piece. You can't be radical. I was radical, but I had a CEO. When I went to my CEO and said, no one else is doing that, he was like, great, let's do it. So he was kind of like, he was convinced everybody was wrong. So if you're going to do the opposite, he was like, let's do the opposite. So that's the only way I could get that done. You can talk to John Toohey about this because he tried to do what I did at AIG. And guess what they said? Too unconventional. No one else is doing it. So you can talk to him. It was a pretty interesting conversation when he interviewed at USA, and us telling him, yeah, we've done that. He's like, man, I can't believe y'all did that. So, all right, so we got this out of line. This is where most of our time is spent. This is the smallest of the risk. This is the second largest, and this is by far the largest. This risk, we put all our time into it, and how good are we at it? We're horrible, right? The industry would be far better off if it just bought index funds, but it doesn't. It tries so hard to beat on peer risk, and it fails miserably all the time. We talked about that. The majority of the time, hiring an active manager, you underperform, you might as well just buy the benchmark. So we spend most of our time here, and we're horrible at it, and we keep trying. Maybe next time we'll do better. So that's what his article is ignoring. This part of it, he doesn't mention this one, but it's somewhat implied. So if we look at his article, this is out on Canvas. It's the one that says rewritten. Most of the risks that get us into trouble are peer risks. Now, he starts off, we won't get into it, but he says, we use standard deviation as our measure of risk in academia, but in reality, it's peer risk is what we worry about. He says, no one's ever gotten fired for standard deviation. You get fired because you underperform your peers. So he says, yeah, it's great in academia, we talk about standard deviation, but this is what we worry about. Peer risk, also known as alpha risk. Have you heard that before? That's falling short of your peers. Asset risk, also known as beta risk. See, that's what he did in the article. Sometimes he said peer risk, sometimes he said alpha risk, sometimes he said asset risk, sometimes he kept switching back and forth. That's just losing money on your assets. That's essentially your asset allocation. How much do you want in stocks and bonds? How much standard deviation are you going to take? And then asset liability risk, when our asset portfolios underperform our liabilities. So he's talking about pension plans. They promise to pay retirees. So he says, this is where I disagree with him, but he says you got these risks. Here's the peer risk, the smallest. Liability risk, I'm sorry, I forget why he meant my real returns. I guess that's essentially investing exactly in the liability with tips. But he's saying these three risks kind of interact and have different levels, and his solution that I don't agree with, his solution is to balance these three risks. Try to get them equal. So he's essentially saying a third, a third, a third. Now, if you have a massive risk and a small risk, would you want to balance those three? So here's my weird saying, I agree, but I think it makes the point. All right? So someone's got a gun to your head. You don't know this person. You never met him before. They got a gun. You know the gun's loaded. Is that a good time to be worried about your cholesterol level? You say, oh man, the guy's got a gun to my head and my cholesterol level is like at 140. Probably not. Now you might say, yeah, but I don't know anything about him, but I know exactly what my cholesterol level is, and I know how to manage that, and I've been doing that all the time, so I'm gonna worry about my cholesterol level right now. Does that make any sense at all? So when someone has a gun to your head, take care of that risk. Cholesterol level, you've got time, it's a much smaller problem. But what the market has said is we can measure this. We know how to do this. We make money on this side. That's why career risk comes in. So it may be the smallest risk, but that's where all our effort is because we know how to do that. So it doesn't make logical sense except for the career risk side. Everybody else is doing it. That's where the industry makes its money. And so that's what everybody's going to do. So kind of strange. So he says balance the three. I say forget balancing the three. Now here's my radical idea. I actually say ignore those two and only do the third one. All right, I'm going to show you why I think that. We did this at UTSA, and it was quite successful during the time I was there. You can argue that it wasn't successful after I left, but that's not my problem. But, stock markets have done well since I left, but our focus was 100% on this. In fact, what we did, we went from this is what I inherited. We spent about an hour every quarter with the committee, which had the CEO and the CFO, all of them on the committee, going through all of our managers. Oh, manager A is doing well this year, manager B is not doing well. No, we're not going to fire them. We may fire them next year. Go through all of them. So do we really want this manager? You know, just truckloads of analysis. We then indexed, we hedged our portfolio, and we went with one page. Y'all want to see the one page we showed our committee? Literally, you're gonna think I'm joking. We were up there for like, I was trying to get my staff more exposure to go present to the committee, and they used to do an hour, now they go and present for 3 minutes. But asset return, 10%. Liability return, 9.8%. No problem. That's what we did. Our assets made 10, our liabilities are up 9.8. We're hedged. Any questions? Saved a lot of time. We're not out there spending massive amount of time interviewing managers, hiring, firing managers, knowing we're going to mess up again when we do it. We tried all kinds of things. Usually if you hire a new manager, they mess up immediately. So we say, let's hire a new manager, but let's wait 6 months to give them money. And then we do that, and then they mess up 6 months later. It was just whatever we do. I remember talking to committee, we had one of our international managers had a great year, and I just kind of facetiously said, well, I don't know if it's luck or skill, but they're just doing well. And the president of the investment company, who was my future boss, he goes, you don't have performance like that without skill. Guess how that international manager did the next year? Horribly. Were they skilled and they just drank some bad water and they got stupid, or what? You know, it's just, who knows? But spending so much time on this, we just eliminated it. You as a committee member, how do you think about this? What is your responsibility? What's your fiduciary responsibility? Make sure your assets are going to be there to pay your, doesn't this do that for you? It does exactly what you need. So I disagree with Arnott. I would go this approach. He says you can't do that, and this is where the career risk is. He says it in here. Will the investment officer or GM be called to task if GM pension plan lags Ford's motor court fund? Of course. You can see the career risk he's talking about. I say you shouldn't care. What if Ford's up 12% because they're doing really stupid stuff, and next year they're going to be down 20? Does it matter that I'm up 8 and they're up 12? Who cares? The key is, am I making sure my participants are going to get paid their pension plan? But he argues that. I think, you know, if he were here, he's a lot smarter than I am. If he was here, I think he'd actually agree with me on a lot of this stuff. But, you know, so you got to face the reality of this industry. This industry is not paid to manage this risk. The industry makes all of its money on alpha risk. That's how it's set up. That's how it's compensated. So if you're not compensated to manage a risk, you're probably not going to manage it. In fact, my gun and cholesterol level is a little bit different because it's not a gun to the head of the investor. The investor has a gun to the head of his client, and he's playing Russian roulette. He keeps pulling the trigger and says, see, no bullet, I did a good job for you. And that's, I'll talk about that when we talk about Taylor. That's his idea of our industry, is we're not even pointing the gun at ourselves. It's at somebody else and just spinning the dial. The other risks matter a great deal. I disagree with them that. That one risk is the only one that matters because that's the reason the pension plan exists. The others don't matter. Harvard University's endowment faced sharp questioning, a 20% loss, even in Yale lost 22%. So he's saying, well, asset risk matters. Losing 20% of your money, I would say if you lost 20% of your money but the liability's down 20%, you know, you're probably okay. Interest rates rise, your bonds are down, but so is your liability. Not really a big deal, but he says that matters. There's is asset risk. But despite the importance of these dimensions, the norm for consultants, he says to focus. What do I say? It's not focus. It's like the only thing they worry about is peer risk. Until 2001, 2002, when the stock market crashed. We had the whole 90s where stocks just went up and up and up. Suddenly 2000 happens and like, oh, now we're worried about asset risk. No one's mentioning ALM risk at all. He shows the risk in numbers. as how much risk is there to the earnings per share of corporations from their pension plans? And he's just showing that ALM risk is the largest. So how do we understand this liability? So I want to make sure I understand this, we understand this one page. So how do the liabilities work? So this is where I really changed. So we're talking about the ALM. How does the ALM work? I changed his paper quite significantly. He has some charts that are really, really hard to read. So I have, here's his article, and here's his written article, here's his article. I try to make it as much like his original one as possible. There he is, Robert Arnott. Do y'all know much about him? Have y'all heard of Smart Beta? Does that sound familiar? He's the smart, I can prove it to you. Arnott, Smart Biscuits, Smart Beta. The key to Smart Beta, there he is again, he's looking a little older there. So videos on Smart Beta. What you should do is do Arnott versus Asness. Oops. Asness. You don't need it for this paper, but go out on YouTube and watch two of my favorite people, Arnott and Asness. Just brilliant, brilliant people. And their debate on Smart Beta. It's a very insightful debate. I don't know what that has to do with Smart Beta, but is it really Smart Beta or is it value investing and all these kind of debates? Really, really intriguing argument. But those are the big names in our industry. So what he does, he has a chart like this, and it's really, really hard to read. Essentially, he's taking a pension plan, he's doing cash flows every single year. So what this is the blue is the benefits, but the yellow is the benefits but discounted. And then he does it again, and it's just really, really hard to read. So what I did in my article, just so you can understand it, is I simplified it and say, let's take a pension plan, but instead of having 70 years of cash flow, let's assume it's a really weird pension plan. It's gonna pay $500 in 3 years and another $500 in 30 years. So it only has two cash flows. I don't know why. So there's like two people on the plan, they get $300 a month, and they both live 1 month after they retire, all right? So that's all we have going for us here, all right? It's a really strange pension plan, but it makes it really easy to understand duration and convexity of the plan. So y'all should be able to create this on your own, off the top of your head in Excel, because it's real simple. So the cash flows are 500 and 500. So they're 50% gonna be paid in year 3, 50% in year 30. So that's your plan. But if you discount it 7%, notice that the 3 year is much bigger. And why is that? Because you discount something for 3 years, you get a much bigger number than if you discount it for 30 years. Y'all know how to do that? 500 at 7%? Someone give me the formula. What's the present value of $500 at 7% for 3 years? Y'all can do this in your sleep. Some of y'all might be in your sleep. Hopefully y'all waking up. Y'all know how to do this, right? 500.
Oh.
What's the present value of $500? 7%, 3 years. All right, I'm gonna pretend like y'all know it and you're just playing, right? 500 divided by 1.07 to the third. Okay, that's that 408. What about 30 years? Are y'all just being quiet? Y'all know what it is. 500 divided by 1.07 to the 30th. What's gonna be the bigger number? They're hugely different, aren't they? And this is really key to Arnott's argument. They're hugely different. So the 3-year cash flow is 86% of your liability. The 30 years only 66. Now in your paper, you got to get this. This is so critically important, not just for the exam, but for you understanding finance. This is just so much cool finance. However, what if the interest rate falls to 5%? What's the liability going to do? Lower discount rate, the liability is going to do what? It's going to jump. So the 408 is going to go from 408 to 432. The 66 is going to go from 66 to 116. Where is most of the volatility coming from? The 3-year liability went up 22. The 30-year liability went up 50. So 2/3 of the volatility of the pension plan is coming from those long cash flows. Why? Because of duration and convexity. That long cash flow has a lot of duration, so it's much more sensitive to interest rates. So while 86% of the liability is in the 3-year, 76% of the volatility is coming from that 30-year. This is bad news and good news. So what is the bad news is it's really volatile. This is causing most of your problem. The good news is it's only 14% of your liability. So what Arnold's saying is you don't have to go out there and put 100% in bonds. You need to just take 14% of your portfolio and put it in long-term bonds, and you'll hedge that 30-year cash flow, and you can eliminate a massive amount of risk. So that's his recommendation. Let's at least hedge the long part of the liability. Now, why is that important? Because most pension plans, when they have 30% in bonds, they're buying 30% in bonds that have like 5-year duration. It's not helping them very much. That 5-year duration is not going to help you with something that has a 20-year duration. So what he's saying is, good news is, it's this long-term cash flow is a very small part of your portfolio. You don't have to do much to hedge out that risk. All right, so very, very important. It's the 76% change, 2/3 of the volatility of the liability is coming from that 30-year cash flow, even though the 30-year cash flow is only 14% of your liability. You don't need much. I definitely agree you should at least hedge that. That's the minimum what pension plans should be doing. That 30% that's in bonds, make sure it's long enough duration to hedge that long-term liability. That does make sense. I wish he'd go further than that, but that's what he's arguing. And not only that, but if you look at the convexity, if rates fall 200 basis points, the liability goes up 50 million. If rates rise 200 basis points, the liability only falls 28 million. That's what we call that positive convexity. So when rates fall, your liability rises a bunch, but when rates rise, it doesn't fall that much. That's what I'm talking about, the asymmetry of the liability. It's much more sensitive to rates falling than it is to rates rising, and that's another big problem that you have. That's called positive convexity. He talks about that in this paper as well. So I forget where exactly he does it, but so the 30 may have a net present value barely 1/6 as large, but is 13 times as long duration. Therefore, the tiny liability contributes more than 2/3 as much to the sensitivity of the pension plan. All right. So there's an asymmetry. These are the numbers he uses. If rates fall, the present value would soar 53%, but if rates rise, it doesn't fall as much. So what does this mean? Here's my sentence. Let me show you his sentence. So I don't like his sentence. And again, he's a lot smarter than him, so I shouldn't criticize him, but I think he wrote this a little fast. He says, for the start, it means most plans are holding too little in bonds that are too short in duration. That's a tough sentence to get through, because he's talking about two things and he stuck it in one sentence. So here's my sentence. Obviously, you'll like my sentence better because I'm grading you and he's not, so y'all can humor me here. It means that most plans are holding too little in bonds, and the bonds they do hold are far too short in duration. It's both things. You need more in bonds, and the bonds you have need to have a long duration. How do you get the long duration? He doesn't mention interest rate swaps, but you're going to need swaps. You're not going to get it from the bond market, so you need interest rate swaps. All right. I agree with him. He's essentially talking about that 10, 14, 15% of the liability. Let's hedge that. I'm saying hedge the entire liability. Just get it out of the way and don't worry about it. So you should read this article. There are some things in this article that are pulled into the exam question, but you don't have to read his. You can read my rewritten one. Wouldn't you love it if you could come talk to the class? I'd love to get him here. Maybe he's retired now and he'd come in by Zoom. I don't know. I'm sure he doesn't remember me because I just saw him once. I did compliment him when I saw him once, so maybe he remembers me. All right, so what we'll do, don't leave yet, but what we'll do next time is I will show you the rubric for this question so you can start thinking about it. I know you're focused on your project, your paper, but I'll show you the rubric. There's some places in here are really, really easy, like the 4 risks that Arnott mentions, the 4 risks of ALM. Some of those are really straightforward, but some of these students really struggle with. We've talked about everything on this list, but now we'll see on Tuesday how much of this you understand, so you can make sure you're ready for the exam question, all right? I can't remember if the exam comes first or the project, but I think the exam comes before the project, if I remember right, but I can't remember. I can't keep track. Huh?
That was on Tuesday.
Well, on Tuesday, we'll walk through this rubric.
Oh.
And then I'm going to talk about USA's pension plan, in particular, not to brag about USA, but in 2008, there were 1,000 largest pension plans in the United States. 999 of them went from a positive surplus to a negative surplus. Only one plan tripled its surplus from 300 million to 900 million. You can guess which plan that was. But we'll talk about what USAA did and why it worked so well. All right, I'll let you go there.